Hello everyone, welcome back to our weekly webinar series. My name is Faiza Hashmi. I'm the tax director here at Crest Cooper. Today I've been joined by my colleague Mahar Afzal, and together we will be taking you through today's topic. So the topic of today is the compliance of the real estate sector. So we will be discussing in detail that what kind of compliances are applicable on the players who are there in the real estate sector. So we will be discussing the corporate tax implications, we will be discussing the VAT treatments, we will be discussing the GoML requirements and the ESR requirement as well. So I will be taking you through the corporate tax compliances for the real estate sector, and then Mahar will continue with VAT, with GoML, with ESR. We have previously also discussed the real estate topic in terms of corporate tax implications earlier as well. So we did one webinar on the free zone based real estate players. We also did a webinar on the real estate investment trust. So if you have missed any of these webinars or any of the other webinars that we weekly conduct, so they are available on our YouTube channel. You can visit our handle is Crest Cooper, and you can have more information about these topics or any other topic that you have missed in the previous webinar. So now coming to the topic of today, like I said, we will be discussing the compliances of the real estate sector. So now when we say the real estate sector, who are the people who are in the real estate sector, who are these players who are affected by these requirements, by these regulations, and these compliances. So there are owners of the real estate property. They are one of the players of the real estate market. Then we have brokers who are in the business of buying and selling the properties. They have usually have a license for that. Then there are developers, people who are, have a development plan. They look for investors. They hire contractors to build, the property. Then we have contractors who are the people who are doing the construction or the maintenance of the property. And oftentimes they are using subcontractors as well to conduct, the construction um, or the maintenance for these properties as well. So these are the real estate players which will be affected by these regulations, these compliances for corporate tax, for OML, for ESR, and for VAT. So, like I said, I will take you through the corporate tax implications on the real estate sector, and then Mahar will take you through the other compliances. So now, in terms of corporate tax, these players or these people in the real estate market, they can either be natural persons, they can either be judicial persons, they can be non-resident, they can be UAE resident people, they can be in the mainland, they can be in the free zone. If they're in the free zone, they can be qualifying free zone persons, they can be non-qualifying free zone persons. So what we have tried to do is to discuss, the taxability of each of them in detail to give you an overview of how, corporate tax will impact these real estate players in the real estate sector. So before we discuss the taxability, let's discuss that what is real estate. So as per the corporate tax law, real estate means any of the following: any area of land over which rights or interests or services can be created, any building, structure, or engineering work attached to the land permanently or attached to the seabed, any fixtures or equipment which make up a permanent part of the land or is permanently attached to the building, structure, or engineering work or attached to the seabed. Now, real estate property can include residential property, furnished holiday homes, commercial property, showrooms, warehouses, storage rooms, parking lots, and garage. These are some of the examples. They can also include structures, fixtures, or similar equipment that are permanently attached to the property. And land, when we say land in the above definition, it can mean agricultural land, industrial land, residential land. It may also include structure, fixtures, or similar equipment that are permanently attached to the land. So in terms of the taxability, let's start with the judicial person. Or what is a judicial person? We know that if the owner and the business they are separate from each other, you can say that they have limited liability. They are not one and the same. Their identity is not the same. Usually, in the case of if it's a LLC company, private joint stock company, public joint stock company, where the liability is limited for the owner. So they're treated as a juridical person, and those companies are separate from their owners. So if there's a company, LLC company is involved in the business activity like investing in real estate or owning commercial or residential properties, it will be subject to corporate tax. The income that it will be earning would be from rental, it would be from maintenance, from purchase and sale of those residential or commercial property. All this will be subject to corporate tax at the rate of 9%. So 0% up to 375 would be taxed at 0%, and then over 375 would be taxed at 9%. And when we talk about the real estate, you can say that all the activity of construction, development, like we said, management of the property, this will also be included, in addition to sale and purchase and owning the property. Now, when we say natural person, now unlike the judicial person, the natural person, they and the business is the same. The owner is not distinct from the business. It's like sole establishments or unincorporated partnership, freelancers. So there, the liability of the owner is not limited; it's unlimited. So they are treated as one, and they're treated as a natural person for corporate tax. So the taxability for a natural person is that if in a Gregorian calendar year, which is from January to December, if the turnover is exceeding 1 million, then only dirhams, then only they are liable to corporate tax and to register and to pay any corporate tax. Now, from this turnover, there are certain things which are excluded, like wages that are being earned by the natural person, personal investment income, and also real estate investment income. So any real estate investment income doesn't matter how much the amount is, it could be more than the 1 million as well. If it falls under that, then it will not be considered for corporate tax. So now the important thing is that what is real estate investment? What falls under this, which is excluded from the turnover? So real estate investment is defined as any investment activity conducted by a natural person related directly or indirectly to sale, leasing, subleasing, and renting of land or real estate property in the UAE that is not conducted and or does not require to be conducted through a license from a licensing authority. So the important point here is that you do not require a license for this. It's like a personal real estate investment. So if it's like a personal real estate investment, you're not doing a business activity where a license is required, then that will not be part of this turnover and this threshold. But if you require a license to do that activity, then it will be part of the 1 million threshold because it will not be real estate, part of real estate investment, which is excluded. Now, when we say that is not conducted or does not require to be conducted, so what it means is that sometimes there could be cases where a trade license is required to conduct the activity, but a trade license has not been or a license has not been taken. So if a license has not been taken from the licensing authority, but you are required to take the license, then you are not exempt from corporate tax. Still, corporate tax will be applicable as long as there was a requirement to have this license. But if there is no requirement to have a license to conduct this activity, then you will be, fall under the real estate investment. It will be exempt. So now the natural person, like we just discussed in the real estate industry, like the brokers, contractors, for them the treatment. So if it is part of the real estate investment, like we discussed previously, then it is not being counted in the threshold, and we will exclude it no matter what the amount is. But if it is, not part of real estate investment, then anything that is being earned through the rental or through maintenance, that would be part of, the turnover. And for the natural person, turnover up to 1 million. So even if you're earning, the rental or buy from the property, buying and selling of the property through a license like a broker, you can say, then even if your turnover is less than 1 million, then even you do not need to register for corporate tax or pay any corporate tax. So that is one of the things to understand here. Now, if your income is over the 1 million, you do need to register, but then you will see that is your turnover less than 3 million. If your turnover is less than 3 million, then there's a small business relief which is available to you. And if you would like to take that, then it is available till December 31st, 2026. And the natural person can benefit from this as well. And they do have to register, but they do have to, file a return, but it would be a simple return where the election of the small business relief would be taken. It would not be like a proper full-fledged return, but the requirement to register would still be there. If you're not falling in the 3 million, if the income you're earning is more than 3 million, then it would be the same treatment as for a juridical person company. And then any revenue basically over 375,000 will be taxed at 9%. So up to 375,000 would be at 0%, and over above would be 9%. So this is a little bit of the difference between the treatment between the juridical person and the natural person. So now these were the resident natural person and the resident judicial person. So let's talk about the non-resident person now. So in a non-resident person, there can be three cases. Either they can be a permanent establishment of the non-resident real estate developer, contractor, subcontractor, or broker. Now that will be liable to be taxed in the UAE just like a company, just like a judicial person in the UAE. However, only the income which is attributable to the PE will be subject to the UAE, and instead of the worldwide income, which is the case for a resident judicial person. So if a non-resident is earning any UAE source income, at the moment there's withholding tax on it, and but that rate for withholding tax is zero for now. So if in future this rate increases, so that would be applicable on any UAE source income that is earned by the non-resident person. And there is a nexus will be created also if there are investments of the non-resident in immovable property. In that case, the non-resident will have to register, they will have to submit a return, and they will have to pay the corporate tax in the UAE. Now, like we discussed before, that in the free zone, they can be natural person, they can also be juridical person. In the juridical person, they can be either free zone person, a non-qualifying free zone person, or qualifying free zone person. So who are the qualifying free zone person? We know that qualifying free zone persons are the people who are meeting all the conditions under the law to qualify as a qualifying free zone person, which are that they are deriving the qualifying income, they are maintaining the adequate substance in the free zone, they are satisfying the de minimis threshold, and they have not elected to be subject to the normal CT. They are complying with the transfer pricing rules and documentation, and they are preparing audited financial statement. So if they are meeting all these conditions, that free zone person can be a qualifying free zone person. Now, the taxability of the qualifying free zone person, it is impacted by the type of activity they are performing, who are their customers, who are the parties they are dealing with, and the kind of property they are handling, where the property is located as well. So for a qualifying free zone person, there can be two type of income, a qualifying income or a non-qualifying income. So any income from transactions with free zone person. So when a qualifying free zone person is engaging in any transaction with other free zone persons, and the income derived is considered as qualifying income unless it is falling in the category of excluded activities. Then it becomes a non-qualifying income. And any income from transaction with non-free zone person, if the free zone qualifying free zone person is having any transaction with non-free zone person, we have to see if it would be a non-qualifying income except for if the income was being derived from the qualifying activity. So under the law, there is a list of qualifying activities like manufacturing, like processing, distribution of goods, operation of ship, logistics services. So there's a list. So if any income is being derived from that qualifying activity and they're not part of the excluded activities, then it will be termed as qualifying income. So we keep on mentioning that it should not be excluded activity. Like if there's a transaction with free zone person, then they have to be beneficial recipients, and it cannot be an excluded activity. If it is a transaction with non-free zone person, again, it has to be from one of the qualifying activity, but it cannot be a part of excluded activity. So excluded activity is also being mentioned in the Ministerial Decision 139 of 2023. And over there, certain property related activities are part of the excluded activities. So what it says is that ownership or exploitation of immovable property is an excluded activity. So any income of the qualifying free zone real estate developer, contractor, subcontractor, broker, it will be subject to 9%, and it will not be part of the de minimis threshold. Now, the only exception that they have given there is for commercial property. So the exception is that if the ownership or exploitation of commercial property is there in the free zone, which involves transactions with other free zone person, then it is not part of the excluded activity. And this will generate the qualifying income, which means it will attract the 0%. Now, what is commercial property? It's defined as any movable property or part thereof used exclusively for business or business activity purpose. It specifically excludes property used as residences or accommodation like hotels, motels, bed and breakfast establishments, service apartments, and similar kind of properties. So if the ownership and exploitation of the immovable property, which is not a commercial property in the free zone, transaction is not with the free zone person, all that will attract the 9%. Okay, so there could be cases where there is a mixed use property. So in that case, if there is a mixed use property, then it will be subject to both 0 and 9%. It will be based on the use of the property. So let's give an example for that. If there is a residential apartment building which is located in the free zone, excuse me, that has retail units on the ground floor. So residential apartment, apartments on the top, and their retail units on the ground floor. So this is a mixed use property. So here, the qualifying income from renting of the retail space to free zone person, this is generating the qualifying income. And the income we are generating from renting of the residential apartment to any person, it will generate the taxable income. So if just to summarize for the qualifying free zone person, a company which is incorporated in the free zone, it will be subject to corporate tax at 0% if it is meeting all the conditions we discussed before. If it is meeting all the 6 conditions and is a qualifying free zone person, it will be subject to 0%. Income which is earned from a commercial property through a beneficial recipient within the free zone will be considered as qualifying income. Income earned from a commercial property located in the mainland or any transaction with mainland person, it will be subject to 9% corporate tax rate. Income earned from residential property will be considered a taxable income. Here it doesn't matter if it is located in the mainland or free zone. If it's a residential property, it will be subject to 9% corporate tax. If the income is derived from a mixed use property, like we just saw the example, then it will be subject to both the 0% and 9%, which will be based on the use of the property. Now, just to give you a bit of summary, so if there is if the developer or the owner or contractor or the real estate players, they are in the mainland, if they are a natural person, which we discussed are like store establishments, freelancers, unincorporated partnership, if their annual income is up to dirham 1 million. So if it's a part of the real estate investment, then it's not included here. But if it is not part of the real estate investment, meaning that you require a trade license to conduct it, then if it is more than if it is up to 1 million, then even you're not liable to register and CT is not applicable. If it is above the 1 million threshold, but it is below the 3 million threshold, then you are liable to register and submit the return, but you can avail the small business exemption up to December 31st, 2026 in the return and file a simplified return. And if your annual income is above 3 million, then you have to register, you have to submit your return, and you up to 375,000 taxable profits will be taxed at 0%, and beyond 375,000 dirhams would be taxable at 9%. Now, if it is a juridical taxable person, the companies, so if the annual business income is up to 3 million dirhams, then they will be liable to register and submit the return. They can avail the small business relief just like the natural person, available up to December 31st, 2026 if they meet all the conditions. And if the annual business income is more than 3 million, if they are resident persons, resident juridical persons, so which can be either if they are incorporated in the UAE or they're incorporated out of the UAE, but they are managed and controlled in the UAE, then again, the income up to 375 would be taxed at 0%, and beyond that, over and above 375,000 will be taxed at 9%. We discussed that if it was non-resident juridical person, then P of a non-resident, any income which is attributable to the P will be subject to tax, same like the juridical taxable person, but they cannot avail the small business relief. If it is the UAE source income which they are earning, then they will not be liable to register and submit the return, and withholding tax will apply on them, which at the moment is 0%. If it's a nexus, due to the owning the immovable property in the UAE, they will be liable to register, they will be liable to submit the return, and UAE source income will be taxable here in the UAE. Now, if they are a free zone person, so if they are non-qualifying free zone person, they can be natural person or they can be the companies, the juridical person. So they will be treated same like we discussed in the previous slide. And if they are qualifying free zone person, then if the property is located in the free zone, it's a commercial property which is used for business purposes. Transaction is being done with other free zone person. It will be a qualifying income, and 0% corporate tax rate will be applicable. If the transaction is with a non-free zone person and the commercial property is being used for business purpose, it's located in the free zone, transaction is with a non-free zone person, then it will be a non-qualifying income and it will attract the 9%. If it's a residential property or a commercial property which is used for living purposes and or not being used for business purpose, any of these cases, then it is a non-qualifying income, and it doesn't matter if the transaction is free zone person or non-free zone person, both cases, it's a non-qualifying income and 9% tax will be attracted on it. If the property is located outside of the free zone, it's a non-qualifying income and 9%, like we said, would be, taxability of 9% will be there on it. So this is just a summary of the free zone person, the mainland person. We talked about the juridical persons, the non-resident persons. We talked about the free zone, qualifying free zone person, natural person, and this is just a summary of that. So there are also real estate investment trusts. So real estate investment trusts, they are a company or trust that make long-term investment in real estate. An investor purchases a share in the trust and earn income through it without having to buy, manage, or finance a property by themselves. So they are called REITs. They have diversified portfolio property, which include residential, commercial, industrial, or retail. They are required to distribute the income to their shareholders in the form of dividends. So these real estate investment fund can apply for exemption from corporate tax with the FTA. There are certain conditions that they need to meet, like the minimum asset value of the real estate asset, excluding the land under the management or ownership of REIT, must exceed 100 million. At least 20% of the share capital of the REIT must be traded on a recognized stock exchange or directly wholly owned by two or more institutional investors, example being government entities, bank, insurance provider. But there's a condition that at least two investors should not be related parties among each other. And REIT must have an average real estate asset percentage of at least 70% during their financial year. If they're meeting these conditions, they can apply for exemption from the corporate tax. If you would like to know more about the real estate investment trust, like we said, we've already done a very detailed webinar on this topic. It's available on our YouTube channel with the handle of Press Cooper, so you can get more information there. Also, the accounting records. So you know that under corporate tax, the companies are required to keep the accounting records like the ledgers, the journal entries, source documents, invoices, contracts. So the requirement for the real estate is 7 years from the year the documents are created. So they need to keep these documents for 7 years. Now I will hand it over to Mahar, who will take you through OML and ESR and VAT on the real estate sector.
Hello, Faiza. Thank you very much. And thank you very much once again to everyone for joining us and welcome back. Faiza, she has already discussed corporate tax, impact of the corporate tax on the real estate players. And what we are discussing today, as she mentioned earlier, we are discussing impact of the compliance requirement for the real estate player. Either they are in the brokerage services, either they are application of VAT, developers, contractors, subcontractors, landlord as a, if they are selling the land and building, if they are selling the building, all these things we're looking into. The objective is basically to make sure to give the more and more awareness to the public, to the stakeholders who are connected directly in the real estate business. So we have already discussed corporate tax. Now we are discussing GoML. For the GoML, first of all, what are the stakeholders these are the stakeholders which are involved. So these are the stakeholders. What are the stakeholders? The first is, sorry guys. So owner of the land, developer of the land, contractors, subcontractors, broker, property manager, and owner of the building. So we are discussing right now GoML. If you wanted to go back into the history of the GoML, you can find one more very comprehensive video on our YouTube channel where you will be able to find how the GoML was started. The crux is basically the loss of revenue. Revenue was being shifted from the high tax jurisdiction to the low tax jurisdiction. There is a revenue loss around 100 billion annually, 250 billion annually. Just to control this loss, the ministers of the G20 countries, along with this FATF, they have decided to bring the OECD, the regulations, and they control the money laundering. And this GoML is part of this, how to control the money laundering. You can very comprehensive, the 15 BEPS action point, pillar 1, pillar 2, all these part of the FATF action points. So GoML is one of them. So in the UAE, specifically related to the real estate sector, as we discussed, what are the direct players in the market? It can be owners of the land, developer, contractor, subcontractor, broker, property manager, and owner of the building. What has been written in the law? As per the law, this is not applicable on the owner of the land. This is not applicable on the developer. This is not applicable on the contractor. This is not applicable on the subcontractor. This is only applicable to the person who is involved in the buying and selling of the real estate properties. Buying and selling, usually brokers are buying and selling, so this is only applicable to the brokers. Property manager, they are managing the property only, this is not applicable to them as well. Owner of the building, this is not applicable to the owner of the building. So GoML in the U is only applicable on the persons who was involved in the buying and selling of the real estate assets. So it has been written in the cabinet decision 10 of 2019, anti-money laundering. Brokers and real estate agents, when they conclude operation for the benefits of their customer with respect to purchase and sale of the real estate, this will be applicable. Otherwise, it will not be applicable. If there is a one company, suppose company A, that company is buying the building, using the building, then after down the line, after 5 years, 7 years, they are selling it. They are not doing the brokerage services. Basically, they are buying, using, and selling. So this is not, they will not fall under the real estate services. Typically, the broker, they are buying the property, selling the property, they will be falling under the GoML services. Important thing is buying and selling the property for the benefits of their customer. If one party is in one company is buying the property, using it and selling it, means they will not be subject to GoML. Only the company buying and selling means the broker will be subject to ESR. This is a link given by the government on the website. You can go through this, you can test it as well. If you wanted to test it, you can go here. It has been written very clearly. Are your real estate firm, your firm carries the transaction with customers involving the buying or selling of the real estate property, real estate brokers and agents? Yes, then it will be applicable. Otherwise, it will not be applicable. So if you are subject to GoML, means you are a broker, you are a real estate broker. If you are a broker, what you need to do? First of all, you need to get yourself registered. Once you will get yourself registered, no timeline given for the registration. In the FAQs, it has been given just after getting the commercial license, you need to get yourself registered immediately as soon as possible. But there's no timeline for this. Better to get yourself registered just after getting the license. You need to go ahead and get yourself registered. Then what you need to do after registration? After registration, you need to do, what is your key role basically? You need to do the risk assessment of the customer to make sure you are not dealing with those customers who are involved in the money laundering. And if someone is involved, you believe there's suspicious transaction, the chances of money laundering, you need to report this transaction to the financial intelligence units of the UAE. So what you need to do, you need to do the risk assessment, mitigation, training of your employees, documentation of your employees, customer due diligence, enhanced due diligence. All these things you need to do. The objective is to identify if there is any suspicious transaction, and if there is any suspicious transaction, you need to report it. So Remote, if you're finding any suspicious transaction, you need to report it very immediately, provide additional information. And for this purpose, you need to provide the training to the employees as well. What the law requires? Law requires you need to put the GoML policies and procedures in place. If you are not putting the GoML policies and procedures in place, you will be subject to penalty. Then you need to appoint the one compliance officer, the person who will be responsible for the GoML in your organization. You need to appoint that person as well. You need to provide the frequent training to your staff. They need to monitoring the transaction, and they need to looking after, okay, they need to understand what is the GoML. Basically, you need to provide a comprehensive training on very frequent basis. Then you need to establish the GoML policies and procedure for screening purposes, so that you will be able to identify any suspicious transaction. If there is any suspicious transaction, you need to report it. The record keeping requirement is there as well for 5 years. So what is the GoML? If I'm asking, what is the practical approach? Practical approach, first of all, you need to assess yourself. Are you a broker? I'm asking typically about the real estate sector. Are you a broker? Yes or no? If you are a broker, you need to go and get yourself registered for GoML. Once you are getting yourself registered, better to take one software from the market. That software will be doing screening for you. Basically, there are prohibited territories, some prohibited organizations. That software will be doing screening for you. Then you need to appoint the GoML officer in your organization. Then you need to provide a training to your team to perform the customer due diligence, customer enhanced due diligence, and to monitor the transactions to identify any suspicious transaction. And if you are finding any suspicious transaction, you need to report it immediately. This is a very practical approach to make sure that you are not subject to penalties. In case you are not doing this, for sure there are penalties, and there are very huge penalties on this. So this is a very high level discussion about the GoML, how it can be affecting the real estate sector. I'm repeating, only the brokers, they need to implement the software. They need to put the policies and procedures in place. They need to nominate the GoML officer. They need to do the customer due diligence. They need to do the enhanced due diligence. Then they need to put the policies and procedures in place to identify the suspicious transaction. They need to report the suspicious transaction to the financial intelligence unit immediately in case they are finding anything. So this is GoML from our side. It will be applicable for sure on rest of the few sectors as well, but we are typically speaking about the real estate sector today. So real estate brokers, this is only applicable on GoML specifically. Now going to the ESR, what is the application of another law of economic substance regulations on the real estate sector? We know this, that the ESR law is applicable on 9 activities. Some are specifically 9 activities, and some are organization based, some are activity based specifically. We'll look into this. If I'm asking banking sector, this is specifically industry. Law says is applicable, but real estate sector, nothing to do with this. Insurance sector, yes, this is applicable, but real estate sector, nothing to do with this. Fund management services, this is applicable on that way as well, but this is nothing to do with the real estate sector. Lease finance business means giving a loans to each other. If this is applicable, this can be applicable on the real estate. If your company, you are giving a loan, you are charging interest, then there is a possibility the lease finance sector, lease finance, giving loan, charging interest, long-term financing. So these are the where this is lease finance business is applicable. If you have a real estate sector, you are giving a loan to your related party, or you are renting out everything. Suppose you have the asset. So this, in this case, lease finance business, there are chances that ESRs can be applicable on the real estate sector. Headquarters, there is a possibility one company is giving the real estate services. At the same time, the company is owning the holding services as well. Then this activity can be applicable on the can be applicable on the real estate sector as well. Shipping business, yes, this is a relevant activity on which ESR is applicable, but for the real estate sector, any of the real estate player will not be involved in the shipping business, so it will not be applicable. Holding company business, yes, there is a possibility. If the real estate sector is a holding company, there is a possibility that ESR will be applicable. Intellectual property, yes, there is a possibility. Distribution, buying and selling the goods to the related party and providing services. If you are doing any such thing, that you buying the goods from your related party and selling anywhere across the globe, this is usually a distribution business. Most of the cases, real estate players are not involving into this, so it will not be applicable. If you're in the service sector business, loss is if you are exporting services to your related party out of the UAE, then you will be subject to ESR. You need to look into this. Is there any services of your entity that you are exporting the services to a related party? If you are, then it will be applicable. Otherwise, it will not be applicable. So what is the crux for the ESR? So banking, no. Insurance, no. Investment funding, no. Shipping, no. So out of the, sorry guys. So banking, no. Insurance, no. Investment fund management, no. Shipping business, no. Rest of the all activities, lease finance business, there is a possibility that you will be subject to lease finance business. There is a possibility that you are subject to headquarter business. There is a possibility that you are subject to holding company business. There is a possibility that you are subject to intellectual property business. There is a possibility that you are in the service sector business. If you are involved any of these activities, then you will be considered, it will be considered that you are subject to ESR. But before this, you need to look into this. Either you are a developer, owner, contractor, whatever is your status, you need to look, are you a natural person? Yes or no? If you are a natural person, ESR is not applicable on you. The juridical person or unincorporated partnership not carrying or trailing activity, ESR is not applicable on you. If you are a juridical person, if you are unincorporated partnership, then you are carrying out a relevant activity. If you are carrying out a relevant activity, we need to look at, is this an exempted licensee or non-exempted? With exempted licensee must submit a notification only to sufficient evidence. In case of non-compliance, you will be considered full-fledged ESR. You will be considered subject to full-fledged ESR. So basically, if you are a juridical person or unincorporated partnership and you are carrying out a relevant activity, the 9 activity out of basically out of this 5 will be applicable on you, remaining 4 will not be applicable on you. If you are carrying out any of those activities, then you need to look into this. You are a juridical unincorporated partnership, you are not falling under the exempted licenses category, then you need to, are you deriving any income? If you are not generating any income from these activities, then you will be required to notification only. If you are generating income, then you will be subject to reporting, you need to comply the requirement as well. So assuming if you are subject to ESR, you are generating income. Once you are a developer, contractor, subcontractor, owner, broker service, and manage property management service, it doesn't matter whatever is your status. If you are doing any of the relevant activity and you are generating income from that, then you need to submit a notification. First, you need to submit a notification, and notification deadline within 6 months from the end of the relevant financial year. Then you need to go for a functional management and adequacy test as well. Seeger test, you need to comply. Direction and management test, you need to comply. You need to have adequate employees, adequate operating expenditures, and adequate physical assets in the UAE. In case you are outsourcing it, these players to whom you have outsourced it, they must be in the UAE. Basically, this area and this area you can outsource. And if you are outsourcing it, the party to whom you have outsourced, they are in the UAE and you have a proper supervision of that. If you are not doing this, it will be considered a non-compliance and you will be subject to penalties. SIGA core income generating activities. This is basically core income generating activity to generate the income. Direction and management test is related to the management. There should be minutes of the meeting annually. One AGM should be in the UAE. Minutes should be held in the UAE. Director should be basically capable director. They need to be able to conduct the business. All these are the requirement of the law. And if you need to comply, in case you are not complying, you will be subject to penalties. After the notification, functional management and adequacy, there one reporting requirement as well. You need to do the reporting within 12 months from the end of the relevant financial year. So important. I'm going back to the we are winding it up the ESR. If being in the real estate, being a directly in the real estate sector, you will not be doing banking business, insurance business, investment fund management business, and shipping business. For sure, these activities will not be applicable on you. There is a possibility the lease finance business, headquarter services, holding company business, intellectual property business, or service sector business is applicable on you. And if this is applicable on you, then what you need to do, you need to submit the notification within the due date. You need to respect the management, functional and adequacy test, and then you need to do the reporting as well. And if you are not doing this, for sure you will be subject to penalties. So now we're discussing VAT on the real estate sector. For the VAT on the real estate sector, I have summarized the discussion. Again, going back to the basic. Are you owner of the land? Are you developer, contractor, subcontractor, broker, property manager, or owner of the building? These are the major players in the real estate sector. Owner of the land. If you are a owner of the land, supply of the land is the supply of goods as per the definition of the law. It means if you are supplying the land, means you are supplying the goods. Once you are supplying the good, there is a possibility that the plot of land that you are supplying, this plot of land is in the designated zone or in the non-designated zone. If this plot of land is in the designated zone as per the definition of the law, this is out of scope. It will not be, because supply of goods within the designated zone is not subject to VAT. If the plot of land is in the non-designated zone, means there is in any free zone or on the mainland. If the plot of land is in the free zone or on the mainland, then you need to, is this a bare land? Sorry. If this is a bare land or this is a covered land? If this is a bare land, it will be exempt. If this is a covered land, it will be straightforward subject to tax. So if you have any plot of land, first of all, you need to look on where this plot of land is exactly located. Then you need to look on if this is a bare land or this is a covered land. If this is a bare land, exempt. If this is a covered land, it will be subject to tax at 5%. Now coming to the developer. What the developers are usually doing? They are buying the plot of land from the owner, they are developing it, and then they are selling it. Now developer, they develop and sell the land and building. Yes. Once they are selling the land and building, again, as I mentioned, the sale of the land and building, this is a supply of goods. This is not supply of services. Even this building is being given on leasing services by the developer, on leasing, still it will be considered supply of goods. It will not be supply of services. So leasing of the real estate is also supply of goods. Selling plot of land is a supply of goods. At the same time, if we are giving any plot of land or any ready units, it will be considered supply of goods. And we know this supply of goods within a designated zone is out of scope. So again, the question is this unit that is being developed by the developer and being sold in the market, is this in the designated zone? If yes, then out of the scope. If out of the designated zone, in the free zone, other than a designated zone or on the mainland, then this is a ready-made property, a ready property or off payment plan. If this is a ready property, then commercial property will be straightforward subject to tax at 9%. Residential property, first supply will be zero rated and subsequent supply will be exempt. Charitable property, first supply will be zero rated and any subsequent supply, it will be subject to tax at 5%. I believe everyone is clear regarding this. Contractor, they are only providing the services related to the real estate, and place of supply of the real estate as per the UAE law is where the real estate is exactly located. If the real estate is located within the UAE, place of supply is in the UAE. If the real estate is located out of the UAE, means place of supply is out of the UAE. And if the real estate is located in the UAE, and it doesn't matter this real estate is in the designated zone, out of the designated zone, it doesn't matter wherever, services are subject to tax. There are no demarcation, there are no basically boundaries of the law whenever asking about the services. The demarcation, the boundaries of the boundaries basically is required for the supply of the goods, but the services across the UAE, these are subject to tax. So if the contractor is providing the services related to a land and building which is in the UAE, it will be straightforward subject to tax at 9%. And if the landed building is out of the UAE, place of supply will be out of the UAE, and it will not be, as per my understanding, these services that are being supplied by a real estate agent, broker, contractor, who is based within the UAE, but these services are being supplied related to a property which is out of the UAE, it will be out of the scope for the UAE law. It will not be zero rated because the place of supply has been shifted from the UAE to any other jurisdiction. So contractor, subcontractor, if the services, broker or property manager, all these are the services. All these parties are providing the services. And if the property related to these services are being provided within the UAE, property is in the UAE, then it will be subject to tax at 5% straightforward. If the property is out of the UAE, even these players are based within the UAE, contractor, subcontractor, broker, or property manager, even they are based in the UAE, property is out of the UAE. So as per my understanding, it will not be zero rated, it will be out of the scope because the place of supply has been shifted from the UAE to the rest of the area where the property is exactly located. Owner of the building. Now, they is the owner of the land. They are given to the developer, developer is developing. Now, the developer has hired contractor, subcontractor. Then at the time of the property is ready to sell, the broker came, property manager came, whatever, the owner of the building. Now, the owner, the owner, here initially we were discussing owner of the land. Now we're discussing about the owner of the building. They have any ready units. Selling or leasing the property. Selling, as I mentioned earlier, selling, either leasing. In both of the cases, this is a supply of goods. Leasing is a supply of goods as well. That is very important. Leasing is not supply of services. Leasing is supply of goods. Leasing, supply of goods. So, supply of goods in the designated zone out of the scope. In the non-designated zone, in the mainland or in the free zone, which is not a designated zone, then this is a commercial property, residential or charitable. Commercial property straightforward, subject to tax at 9%. Residential, first supply zero rated, subsequent supply exempt. Charitable, first supply zero rated, subsequent supply 5%. So this is straightforward, very comprehensive, very comprehensive summary of the VAT law regarding the owners of the building, owners of the plot of land, developer, contractor, subcontractor, broker, property manager, and owner of the building. So wherever the supply is straightforward 5% or 0%, you will be able to claim 100% input tax. Wherever the supply is exempt, your input tax will be blocked. Here your input tax will be blocked. Here your input tax will be blocked. Here your input tax will be blocked. Means whenever you are supplying bare land in the non-designated zone, in the mainland or in the free zone, your input tax will be blocked. Whenever you are supplying, developer is supplying the ready units, ready residential unit, not commercial, and this is the subsequent supply other than the first supply, the input building, any subsequent supply of the residential building is exempt and input tax will be blocked. Now there is a possibility that any of these parties, they are giving services, so it will not be apportionment of input tax rule, it will not be applicable on these parties because these parties will be able to claim 100% input tax. So there is a possibility that developer, owner of the building, or owners of the plot of land, if the developer is selling commercial as well as residential building, here owner of the building selling residential and commercial, when I'm asking residential means any subsequent supply. Now first supply, they will be able to claim 100% input tax. I'm asking specifically subsequent supply. So there is a possibility that the common input tax, some will be relating to the commercial property, some input tax will be relating to the exempt property. So you need to apportion the input tax. The apportionment principle has been given in the law as well. You can go through this. Some important thing, short-term tenancy, if the building is being provided, even this is a residential building, subsequent supply, if this building is being provided to anyone who doesn't have the Emirates ID or to anyone for a period less than 6 months, law says it will be treated a commercial transaction, it will be straightforward subject to tax at 9%. Labor accommodation, important. If this labor accommodation residential supply, if the residential building supply, if the company is taking the building on lease, may it will be exempt supply. Once the company is taking the building on lease, there is a possibility company is using the building for business purposes. The company is not charging to the employee. If the company is not charging to the employee, means company is not further supplying. Once the company is not further supplying, means the company is using the building for business purposes. Company will be able to claim any related directly input tax like cleaning, maintenance. The company will be able to claim it. But if the company is giving the building to the employees for residential purpose and company is charging them, once the company is charging them, it will be considered supply by the company. Even this is a building owned by the property, even this is a building taken on lease by the company, it will be considered further supply. Once it will be considered a further supply, company is charging to the employee, and this charging may be deduction from the salary, any extra invoicing. So any might be, so if the company is charging to the employee, then it will be considered supply and input tax will be blocked related to that building. As I mentioned, if the company is not charging to the employee, it will be considered business use. Company will be able to claim input tax. If the company is further supplying building to the employee and company is charging to the employee, then it will be straightforward considered business use. There is a possibility, then there is a constructive obligation of the company. It is not a legal obligation, constructive obligation of the company, that the company has a residential building, that residential company is supplying to the employees, and it is a part of the contract. It means if this is a part of the contract, means company is charging them. Once the company is charging them, principally it's a supply, it's exempt supply, company should not claim input tax. So first supply, what is the definition of first supply? First supply will be zero rated. First supply will be zero rated for the residential building. First supply will be zero rated for the commercial building as well. Sorry, not commercial, charitable building. Charitable building, residential building, first supply will be zero rated. Law defines first supply means the property needs to be supply, either sale, either lease within 3 months from the date of completion, 3 years from the date of completion. If the property is not being supplied within 3 years from the date of completion, then it will not fall under the definition of first supply. It will be straightforward considered exempt supply where input tax will be blocked. If you wanted to claim the input tax, you need to supply the completed building within 3 years from the date of completion to claim the input tax. Otherwise, your input tax related to residential building or building for charitable purpose, it will be blocked. So transfer as a going concern, if there is a commercial building and this commercial building ownership is being transferred, tenants are same, contracts are same. Initially it was the owner one, now the commercial building is being transferred to the owner two, then law says it will be considered out of the scope. Even this is a commercial property. This is only applicable on the commercial property. Bare land and covered land, we have already discussed. Bare land means that no work has been done on the land. This is a plain land, no work has been done. Covered land, they have done some work. There's some sort of support. There's some sort of building infrastructure is over there. Then this is called a covered land. Bare land is exempt supply. Covered land is standard rate supply. And for the covered land, we need to look into this, as I mentioned earlier as well. This covered land, it will be considered straightforward. Standard rate says it will be considered place of good place, so the supply of goods and supply of services. Infrastructure cost for the developer. They are developing the land. They incurred infrastructure improvement cost. This will be normal overhead for them. They will be able to claim input tax. Off payment plan we have already discussed. These are not the ready-made properties. The properties, I think off payment plan we have not discussed. Yeah, you can go. Off payment plan is advance, written few lines. Advance, I said advance. Whenever the off payment plan, the company developer is getting the advance and making the delivery of the goods later on. Advance, they need to issue the tax invoice within 14 days from the date or receipt of advance. Within 14 days, they need to issue the tax invoice, and treatment will be same. If it is a residential building, 0% invoice. Commercial building, 5% invoice. So this is the same treatment. This is the off-payment plan, taking money now, giving the delivery of the property later on. Inducement. Sometime landlord pay a prospective tenant to enter in. Basically, some sort of incentive landlords are giving to the tenants to enter into the lease agreement. And these incentive losses, these are being given to the tenant, and if it will be considered supply by the tenant. If the tenant is a VAT registered party, tenant needs to issue a tax invoice and need 5% VAT. Rent-free period, the no consideration, the tenants, landlords are giving, again, the landlords are giving incentive, they are giving rent-free period. They are asking, okay, pay rent for 12 months and your rent will be started after 3 months. You can stay there for 15 months. You can stay there for 15 months, but you need to pay rent for 12 months. There can be a deal in between the landlord and the tenant. If there is a deal like this, the law says if you are not receiving any consideration for the period, it will be considered, it will not be considered supply. And if it will be out of the scope. Now, if you are receiving any consideration for the free period, then it will be subject to tax. Lease surrender, if you are surrendering the rights, you are getting any money, that will be subject to tax if you are a tax VAT registered party. And if you are not a VAT registered party, it will not be subject to tax. Dilapidation payments, cost of restoring the property. This cost of restoring the property is written in the guide. If this cost is in the form of compensation of damages, it will be considered out of scope. And if this cost is for the repair and maintenance you are charging to the tenant, then it will be considered taxable supply. It will be subject to tax. Retention payment, retention, there is no special rule for the retention. If the retention considered to already been completed, if the building has been completed, work has been done, it has been accepted by the owner, then any of these three things, invoice, money, whichever is coming earlier, it will be subject to tax. But sometimes owners are holding some portion of the money, 10%, 15% as a retention payment. They are usually releasing this money after the defect liability period. Once they are holding this money and releasing after the defect liability period, so means the portion that they are holding, it means for that portion supply has not been completed. So for that portion, whenever you are issuing invoice, receiving money and getting confirmation from the customer that this supply has been completed, defect liability period is over, they are satisfied with the work, then it will be considered a point of supply, it will be subject to tax. So 90%, assuming you are receiving now, 10% customer is asking defect liability period is 3 years, and after 3 years, they have released you the money, or defect liability period, nothing is wrong, means it will be completed that yes, work has been done, it's satisfactorily accepted by the customer. So whenever they are accepting the job, whenever they are releasing the payment, whenever you are issuing the invoice, out of these three things, whichever will come first, it will be subject to tax. If you are issuing invoice today, defect liability period is 3 years, you will be subject to tax today. But this is not compulsion for you to issue the invoice today. But the reason is the customer has not accepted the job because there is a defect liability period. You need to wait for it. Better, you need to issue invoice at the time of receipt of money. You need to pay. Otherwise, you will be liable to pay tax from your pocket. Snagging is there. Snagging is process of checking a newly completed building for minor faults. The developer or builder, builder, contractor, they have developed the property for you. You are the owner. Once the contractor, subcontractor has built the property for you, there is a chance that there is some sort of lacking, there's some sort of building faults are there. Now the possibility is, are you asking the same contractor to fix the fault? If they are not charging you anything extra, then it will not be considered further supply and it will not be subject to tax. But if you are hiring any third party, a third party is charging for you, that will be considered supply by third party, it will be subject to tax. So this is over from my side, our side. Thank you very much for being with us. Thank you very much. So if you have any specific question, you are most welcome. I think 3 questions are there. I'm not able to. Why I'm not able to open it? Let me, okay. Can you please go one slide behind? Which slide you are asking about? I'm happy to go back right now. Anand is asking one question. Can you go one slide behind? I don't know on which slide I was exactly at that time. Zishan is asking, appreciate the great effort about ESR. It is no longer applicable after December 2000. Yes. Zishan Rashid is asking, can you share your insight on this as well? We will have one more session that will be discussing further in detail. So if you have any further questions, you can approach me. It would be really helpful for me to go through this. It will be honor for me to support. Any further question, you are most welcome. Anand, you can drop me an email if you have any specific question. Okay, guys, take care. Thank you very much and have a lovely evening. Thank you very much, Faiza.
Thank you, everyone.
Thank you. Thank you. Bye-bye.